Right now, financial markets are nervous. Real nervous that America and the world are headed for a recession. That's pushed long-term interest rates in America close to 20-year highs. US mortgages are the highest since the year 2000. Oil prices have plunged. Chaos, you might say. Well, let's bring in our business editor, Ross Greenwood. Ross, good morning. What's got the market so spooked at the moment?
Well, it's spooked really, Pete, about a number of things. But the fact is that it's spooked about the fact that inflation is not going to disappear, that the central bank, the Federal Reserve, is either going to have to leave interest rates this high for a long, long time, or indeed might have to raise them again. And that goes also for Australia's Reserve Bank. And so we can show this to you in a number of charts. It gets a bit technical, I know this. This is a yield curve. So this shows you short-term interest rates and basically goes out to long-term interest rates. Normally, imagine, you'd expect to get more interest for the longer you put your money aside. But you can see here in the blue line, that's the current line, there's actually more interest for short-term rates than there is for long-term rates. But what's happening is that those long-term rates, you can see, are rising over a period of time. You can see how it's changed that yield curve over the past 2 years or so. The other thing about this also is generally when there's an inverse yield curve like there is now, with lower rates higher than longer-term rates, that's a pointer to recession. It's perhaps the best pointer to recession. So what's happening is that long-term interest rates right now are being driven sharply higher, and that's pushing up mortgage rates in the United States, as you say, to the highest in some 24 years. This is where they are. Remember, US mortgages are different to Australia. They have 30-year fixed rate mortgages. So when you take out a mortgage, that's it for the next 30 years. Here in Australia, most of ours are variable. We can get 3 to 5 year fixed rate loans, but mostly here, of course, our rates will move with the money market rates. But in America, that is seen to be really crimping the ability for people to buy homes and indeed to want to buy homes. And so that has a detrimental impact on the overall economy. So this really is, if you like, pointing to, number one, significant volatility in the markets, and also, secondarily, also potentially what takes place in terms of the economy going forward right around the world.
Okay, so what's this got to do with us here in Australia, Ross?
Good point, because of course, whatever happens in America happens here in Australia as well. So here we see long-term rates going up, but it's also seen in the Australian dollar. If US interest rates are this high, what happens is that money basically goes from around the world into US dollars. So right now, the Australian dollar, which was 62.8 US cents only a day or so ago, it's recovered a little today, but it's really come down and will be under pressure while this takes place. You can see here, oil prices also, they've gone down. If the world is slowing down, the world doesn't need as much energy, so oil prices have come off big time. So say, for example, even your own fuel prices, which have been out around $2.20 a litre, depending on where you live, well, they're probably going to come off a little, but that's going to be offset by that Australian dollar being lower. So these are the types of things that really, if you like, affect us here in Australia. And of course, the reality is that if there is increased potential for a financial shock in America, there is increased potential for a financial shock here in Australia, though it's fair to say our Australian government with less debt is better prepared to cope with that. The states aren't, but the federal government is, to actually cope with it than other parts of the world right now.
So what's the bottom line?
Bottom line is that risk is much higher. And so because risk is much higher, people have got to anticipate that, number one, stock markets are going to be highly volatile, and they have been in recent times. Our stock market falling off really from, its peaks in August when most of the companies were reporting their profits at that time. And this is really also a consequence. If you have higher money market interest rates, you have lower stock markets, and you have then some nerves around our property markets as well. The banks, the government, many others will be worried about this. They'll be watching it. It's not to say it's going to happen. It's just saying that the risks are getting higher right now.
Okay. You got any good news in all of this, Ross?
I don't think so, actually. It's pretty bad, isn't it, the whole thing? Can I tell you, it's Friday. The weekend's going to be good. You can chill out and have a bit of a relax and just forget all about this
stuff. Not if these flies are about.
Yeah, exactly. That's the idea, isn't it?
Yeah. All right, Ross. Thanks for your time. As always, talk to you soon.